This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
And welcome back to the Vancouver Commercial Real Estate Podcast. I'm your host, Cory Wright.
And I'm your co-host, Rod MacKay.
So Rod, I have to first off, thank you for filling in last week. I was riding the Matterhorn in Disneyland, which felt like over and over and over again. But I do have to say, I did have a chance to listen to your episode. You're sitting in again this week for us, which we can't thank you enough for. I'm a little concerned for my job.
Well, you know what? You should be. But I got to say, I think part of it was I was sitting where you're sitting now last week. Something about it felt a little more powerful. Sitting here today, a little bit different, I got to say.
Well, I'll tell you what the problem is. This is Adam's chair that I'm in, and you're in my chair. So
okay, I see.
If you're sitting in Adam's chair, he's the boss. So that's where all that energy and that power is coming through.
Yeah, we're just playing musical chairs here. Yeah, no, so it was Seamus and I last week. We had a lot of fun with Nigel Clark. But this week,
who do we have this week?
Robert Trasolini and Laurent Munier of Safe Pacific Financial. They're an insurance and financial services firm right here in Vancouver, British Columbia.
So what's great about having them on the show is a lot of people don't understand about life insurance policies and how you can potentially leverage against your life insurance policies and sometimes the tax problems that can arise upon death when you're inheriting a real estate portfolio. So today they go and they talk about both sides of that equation and how you can protect yourself against that.
Absolutely. I think a lot of people don't really understand that you can use life insurance as an investment tool. Everyone thinks it's pretty cookie cutter. You know, you pay into your policy, something happens, your beneficiaries get paid out, but you can use it for a lot of great things with a lot of great tax advantages.
No, it's a really, really good, interesting episode there. So without further ado, let's cut to the episode. I know listeners are going to love to hear what they have to say. I'm sure there's going to be a lot of people reaching out to ask more questions about it. I know I learned lots from this episode. So without further ado, let's get to that episode. This week's episode is brought to you by our great friends at Impact Commercial Group.
Really enjoy working with Impact Commercial. And we should say Al and his team can basically do anything when it comes to lending.
Anything when it comes under the commercial umbrella. You're building a building in development, we got you covered. You're buying land, we'll make that happen for you. You're investing in a property or multifamily building, check. Owner-occupiers looking to acquire their own space, double check. Anything commercial financing you need, Impact Commercial is your go-to.
ImpactCommercial.ca. And we should say over 50 years of combined experience. So trust these guys. They're the right fit.
Best in the business, in my opinion.
All right. So today we've got Robert Trasolini and Laurent Munier of Safe Pacific Financial. They are an insurance and financial services company right here in Vancouver, British Columbia. How are you guys doing today?
Doing well.
Thanks so much for taking the time to join us today. Can you maybe tell our listeners a little bit more about yourselves?
Yeah, maybe I'll start us off. Safe Pacific Financial is my company with Laurent. We've been in the investment insurance space for over 12 years. Our focus is really on the life insurance side, mainly working with corporate clients, a lot who invest in commercial real estate. And we're independent brokers. So we work with every major insurance company in Canada. So anything with a life in it, we can work with them, the Canada Life, Sun Life, Manulife, et cetera, of the world. Yeah, and based in Vancouver, born and raised here, got 2 kids, third on the way. And that's kind of a bit about me and Safe Pacific. Laurent, are you going to add anything?
Yeah, let's do it. My name's Laurent here as well. Been in Vancouver almost all my life. Further to kind of what Rob's talking about there, what makes it relevant for your audience is that we really specialize in a niche of building really high cash value whole life insurances that you can use as collateral to secure loans. People in commercial real estate often need to secure loans, so it goes hand in hand.
So let's dive right into that today, because obviously that's a very intriguing thing. So let's maybe start off step number 1. Can you maybe sort of better explain to us what a life insurance policy is and the types of different policies and how they can actually build sort of equity within that plan?
Yeah, I think most people think of when they think of life insurance, they think of what's called term life insurance, which is kind of, like, again, how most people think of insurance in general, where there's no asset build up, there's no investment component, it's just insurance. You pay into it. If something happens, money pays out. If nothing happens, money's gone. Where people aren't as familiar with is what's called permanent life insurance. And that's where you're actually building up an asset, building up cash that you can actually use for other investment purposes. And that's kind of what we mainly focus on. And there's a few reasons why we do that with corporate clients. And we can kind of chat a bit more about that, of course.
Yeah, absolutely. So let's dive into it. I mean, you mentioned that typically when people think of life insurance, they're thinking of a term policy where someone passes away, there's a payout to a beneficiary. But really what we want to discuss today is, how you can build wealth through these policies and use it to purchase assets like commercial real estate. So how does this work? How can you do it? And what types of people use this types of insurance?
Just to back this up, maybe I'll start with the why, like the reason why are we even talking about insurance, right? It's because it's got its own tax status in Canada. It's actually got its own legislation. So insurance in Canada, life insurance in Canada is tax exempt. And then the growth within these policies, which comes from a dividend paid out by the participating fund, the growth within these policies is tax deferred until you withdraw it. And then what we're going to talk about, you never really withdraw. So that tax never happens. And then when it pays out tax free. So this is why we're using it in the first place. And because it's so secure and you're able to collateralize it to secure financing.
Yeah. And so why most of our clients are really doing this. So a lot of our commercial real estate clients, why they look at life insurance, right, is maybe they've built a portfolio of real estate holdings. So let's say they bought, 4 or 5 commercial buildings with you guys or over the course of their life. And now those buildings, maybe they bought it for $1 million, right? And now the building's worth $5 or $10 million, whatever it is. Ultimately there's going to be a capital gain when they pass or transfer these buildings to the next generation. So a lot of times we're looking at life insurance from that perspective, where it's saying, okay, how can we cover this future capital gain from an estate planning perspective? And life insurance obviously deals with that, where they don't have to necessarily sell the building. And then the other is saying, well, okay, great, we need life insurance to cover this future tax bill that's on the horizon. But we don't necessarily want this money that we're putting into this insurance policy getting in the way of us purchasing additional real estate. So how can we turn the life insurance policy, 1, to deal with this estate concern, and 2, but still allow us to buy more commercial real estate where we don't lose our liquidity by putting, so thus making, where it's not as much of a cost for this policy, if that makes sense.
Yeah, absolutely. And we've talked about this before, but maybe for the listeners, can you talk about why these policies, A, are so secure, and B, why they're tax exempt?
Yeah. So Laurent touched on a little bit there. Within Canada, there's the Bank Act, and then there's the Insurance Act. And the insurance companies in Canada are actually older than Canada itself. Like if you look at, Manulife, Sun Life, Canada Life, they've been around for, longer than Canada. First president of Manulife was John A. Macdonald. So actually the Insurance Act is older than the Income Tax Act. So what we've seen is insurance has always been kind of treated separately or exempt from a lot of new tax rules that come in. And there's good reason for that. You want insurance companies, you want profitable large insurance companies. Obviously, they're doing a service for society, providing income, et cetera, those sorts of things. So, but there's some great tax planning tool that you can use, again, to cover capital gains, but also grow wealth over your entire life in a tax-free manner. So from a security standpoint of what you're actually investing in with these policies, usually we're looking at like what's called a participating whole life insurance policy. We're investing within these policies. Why? Because the growth within the policy, like Laurent mentioned, is tax deferred. And then that is invested with the insurance company itself. So the money on these that you're investing goes with the insurance company. The insurance company has a giant pot of money, and they go and invest that money, mainly in bonds, very secure investments, some real estate, commercial real estate as well, private equity, that sort of thing. These companies, like again, Canada, Sun Life, Manulife, the large ones, haven't missed dividend payments since inception. So we're talking world wars, Great Depressions, 2008, COVID. They've never ever missed, and that's kind of what the return is on the policies. They pay a dividend based on their profits. So the investment component also doesn't go down. So the investment component of the insurance policy, once it pays a dividend, that money that's in there, the investment component won't go down. And so the advantage of that from what we talk about down the road, a lending perspective, is banks really like these policies to then use as collateral that you can go purchase other assets.
And so, Rob, let me just jump in here. When you say banks like these assets, they like it so much, they'll do a loan to value on these things. Again, depending on your credit, but they'll do a loan to value of 80, 90, or 100% of the premiums that you're putting in. So now if you think of like what loan to value will they give you on real estate, it's not 100%, that's for sure. So that's how secure these insurance policies are and why the bank likes them so much as collateral for loans.
So can we sort of break down a little bit on a sort of like say the monthly level? So typically you have your term insurance. I pay $150, $200, $300 a month because I'm 35 years old. I got 2% body fat and I run a marathon every morning. I'm not a liability to the insurance, so I pay next to nothing. But let's say I'm 40 years old, I'm overweight, and I have red hair. I might pay $350 or $400 a month in my term.
Sure.
If I die, the money goes to my family. If I don't die before the term does, the money goes to the insurance. And this is probably a separate podcast, but I'd be interested to find out how much of that money ever gets paid out. But let's say I go and
2%.
I do how much?
Not a lot.
I was going to say, I can't imagine. So let's say, for example, I'm going to go the other alternative route. Am I paying more than I would for a term loan or a term insurance policy? And how much more? And then I guess as a follow-up question, because I'm asking like 5 questions here at once.
Yeah.
I was away last week, so I'm trying to get them all in here. So how much more am I paying? And then what percentage of that is actually getting invested if I were to look at it on an annual basis? Am I accruing in these investments within my policy?
Term insurance is great and it absolutely serves a purpose and it's important. But what we're talking about is a completely different thing. It's not comparable apples to apples. So when we decide on a budget that somebody's going to be doing for one of these whole life policies that they're going to use to secure the loans, we're not really looking at like how much are they paying for the insurance up front. It's more like how much do you want to put aside to secure. So, often it'll be like hundreds of thousands or millions of dollars a year, right? So it's not comparable to like a few $100 a month term policy, which most people should just have anyways. But sorry, go ahead, Rob.
Yeah. So usually what we're doing is, this is what is called participating whole life or whole life insurance. So it's more of an asset. So with term insurance, right, like you're saying, if you were to pass in that time, it pays out. If not, it's gone. It's not an asset. Where permanent insurance, that money is going to pay out at some point in time. So, if you have $1 million of permanent insurance, that $1 million will pay out. So as you get older, that piece of paper becomes more and more valuable. So there's an intrinsic value. But kind of to touch on what Laurent was saying, a lot of our clients, one, we'll look at, again, what's that maybe from a commercial real estate, to go back to commercial real estate, maybe there's a future need of, a future tax liability of $20 million. That will happen on death. Well, maybe we want to make sure they get $20 million is one thing, but the other is maybe they want an investment vehicle or to use it as a savings vehicle. And so what clients will do is, let's say that, like Laurent said, let's say they put in $500,000 a year into life insurance policy, which some of our clients do. They'll put $500,000 a year into the insurance policy. That money is now invested with the insurance policy, most companies are paying a 6% dividend. They get their 6% dividend in a tax sheltered manner. And then what we do is they want obviously that money to then go and turn and go buy more real estate. So what we'll do is we'll go to a third party bank most of the time and collateralize the policy. And they'll a lot of times secure them a loan for $500,000. So again, client puts in $500,000, invests it in a tax sheltered vehicle usually within their corporation. Their corporation gets a line of credit for $500,000, which they turn around and use to purchase commercial real estate or commercial property.
So let's say I've got $500,000. I take it out. I use a bank to take a loan of the $500,000 out. You mentioned that I'm getting, let's say, a 6% dividend. I take that $500,000 out, invest in property. Am I still getting the dividend on that $500,000, or does that go away?
Yeah, so it's just like any another asset. The $500,000 still in the insurance policy, right, growing. You're just using it as collateral to secure you a favorable loan. And so you're earning the 6%. The whole idea is you're earning that tax sheltered 6%, deducting the interest on the loan, and then using that loan money to invest in real estate. Hopefully you can get, I don't know, you guys are the cap rate experts. I know you've been following, maybe Nanaimo, you can get 5 or 6% or something like that. And so you can kind of double dip on the same dollar, right?
Yeah, Nanaimo. It sounds like we've got an avid podcast listener here. That sounds almost too good to be true. I've got $500,000. That's the first part. That sounds too good to be true. But I can take it out, still earn interest on the money while putting it in another asset like commercial real estate, and let's say, earn another 5% cap rate. That sounds too good to be true. So
it's no different than real estate, really.
You're doing a Smith maneuver with an insurance policy.
And just for all the listeners know, I signed the paychecks, and it's not unrealistic to think that Rod doesn't have $500,000 because I signed the paychecks. Rod might have $500,000 for all we know.
I heard Rod's just been killing it at William Wright.
Well, he's recently traded his car in for a dump truck because we have to put all the money in the back of the dump truck every time he pulls into the office so he can get it to the bank.
I appreciate that, guys.
Roderick Dump Truck McKay.
Well, I'm so flustered now with all those compliments that I don't even remember what the follow-up question is here. So I'm going to pass it over to Cory here.
So
Roderick, just to continue on how does it work? Why does it work? It's very similar to real estate, right? So you can put your equity into real estate, and then you'll have hopefully you have some sort of appreciation, and then you leverage against it, right? Just because the building is leveraged against doesn't mean that the value doesn't keep going up, right? So it's the same with these insurance policies. You've got the cash in the policy, it's earning the dividend. Because it's leveraged at a bank, like it still earns the dividend, right? Like the policy doesn't know or care that it's leveraged.
The goal really for the clients is to deal with that, the future liability, which you talk about, which is why you'd want life insurance in the first place. But two, being able to deal with that future liability, and also still buy the real estate. Because again, like we're saying, the biggest complaint that most people would have is saying, well, I got to tie up $500,000 or whatever X amount of money to deal with this $20 million liability. That's great. But what if I want to buy more real estate? I don't want to have to tie that money up and not have access to it.
Yeah. So when the business owner, like kind of the problems that they solve in order is, number one is often they'll have the money in the company, right? So that you've got it inside your operating company or your holding company. And it's like, what do I do with it? So obviously you're buying commercial real estate on this podcast, but then also like in order to get that commercial real estate, you always need to get the loans, right? So this helps you to secure different types of lines of credit, or just the line of credit that you can make as big as you want, right? And then while you're securing that line of credit, the cash that you're using to secure it is growing with a dividend paid by the participating account of this insurance company, right? And then eventually you need this thing to pay out so that you can transfer the legacy to your family, and they don't have to sell buildings to pay tax, or they don't have to find tax money somewhere else, right? It's like, here you go, the insurance pays for it.
Can we talk a little bit about that tax aspect of it? So I don't think a lot of our listeners would understand. So I'm Rod MacKay Jr.'s. I'm his son, and Rod passes away, and I inherit a $50 million portfolio of real estate that Rod's accumulated over his life.
Amazing.
What type of taxes would I be subject to if I'm inheriting that portfolio? Can we maybe talk a little bit about that?
Yeah. So we're not accountants. So I just do the whole disclaimer thing. We're not giving accounting advice here. But the short answer would be, especially if it's owned within a corporation, what would happen is there'd be a deemed disposition of your shares of that company. It would be, what that means is, in layman's terms, what it means, it would be like you selling your shares of the company at that time. So it would be, there'd be a capital gain, or there'd be a capital gain owing at that time. As if when you died, it would be like if you sold everything.
Gotcha.
So if you bought that $50 million portfolio and you paid $10 million for it, well, there's like a $40 million capital gain that'd be owing on death on your final return. Now, so that's one challenge. So there'd be a huge bill there. The other is now your $50 million portfolio, let's say you owe $20 million in tax on that. Yeah, Roddy Jr. has to come up with that. So he has to sell, say, a third of the portfolio, right? Or more to pay the tax liability. Now it's more of like an estate sale where you're actually going out trying to sell the properties, or you have to go get financing to now mortgage these properties in order to pay the tax bill. because it's due right away. So
or you would have to save while you were alive. You can start saving now, expecting this $20 million bill later.
So now Roddy Jr. kind of has to figure out this whole tax bill. It's due right away on death or when they file that final tax return. So it can be a bit of a challenge, and it is not the most ideal situation from a planning perspective of like what's the smartest thing that you can do financially.
Everything that Rob said as well. Hopefully, you like your brothers and sisters, and they like you, and nobody's fighting over this. And you owe $20 million.
What a nice thing what you would do is you set up a permanent life insurance policy, right? Let's say it's $20 million. When on death, when the individual passes, the life insurance pays out to the corporation. It then can be used. It's completely liquid, usually 2-3 weeks. Check is there. It can be used to cover any of those taxes, keep the estate intact, not having to sell off all those properties. The other thing is when life insurance pays to a corporation, it increases what's called a capital dividend account. And what that means is it's a notional account that allows that money to go from the corporation to the individuals all tax-free. So if you had $20 million cash in a company, right? Roddy Jr. let's say takes over the company. There's $20 million in the company. He wants to pull the $20 million out. Well, he's going to have to pay dividend or income tax on that $20 million. He might net, 10 or maybe 12 or something like that. So if instead that $20 million is paid out via life insurance, then that $20 million would pay to the company, and that $20 million could flow out through the capital dividend account, or a majority of it, to Roddy, all tax-free. So that's kind of another benefit of life insurance within a corporation.
So worst case scenario, Rod gets 12 million. Best case, he gets 20.
Yeah, and that's the kind of things when you sit down and do estate planning. It's like, well, if you do nothing, this is kind of the tax liability. This is kind of how it plays out. If you do something, we can set it up with an insurance policy. This is all the tax savings. It might save $5, $10, $20 million, and it doesn't affect your ability to buy more real estate, which is the idea.
Sounds like a bonus.
So I'm just trying to wrap my head around, if I'm trying to buy a property, let's say 6 months down the road, is it worthwhile to put a bunch of money? Let's say I wanted to put $300,000 into the property. If I put that into a whole life insurance policy today, can I pull that money out a few months down the line, or what's the time frame like on that?
Yeah, totally. Yeah, I'd say a couple of months. Usually, we have clients, doing kind of exactly that on the commercial real estate space. They'll put the funds, say, call it, $300,000-$400,000 into the insurance policy, and then a month or two later, we usually while we're setting up the insurance policy, we start the conversations with private bankers to do the lending at the same time, where you put in the $300,000-$400,000 and then the line of credit is secured as soon as the policy is set up. And then you have that line of credit that you can use to, purchase more real estate or, do what you want with it.
Actually, sorry, let me back up there a little bit. There's still like an application process. Like if somebody phoned today and said, I want to get this started, don't have like a commercial property closing in 2 months. Like it's going to take a little bit of time the first time. After that, it's very quick. But the first time to get this thing set up is going to give it like 6 months. It could be a year, depending on if things are complicated or if your taxes aren't done and things like that.
So, and also with that, when I'm applying for the line of credit, I'm going to my Schedule 1 bank that I always use, and I'm applying with them, or am I applying with someone else for that?
Well, you usually go, it depends. If you're buying commercial real estate, usually you're going to talk with a commercial banker, right?
Yeah. So it's part of my transaction or my mortgage application documents. I'm going to leverage this as an asset there.
Exactly.
Gotcha.
Yeah. So, but the people in the bank that would know what you're talking about if you did this. So it won't be somebody at like a retail. It won't be a teller or a manager or whatever. The private bankers can do it, and commercial bankers can do it. Otherwise, they probably have no idea what you're talking about if this is something that you want to do. But we would facilitate this whole thing. We work with a few of we work with the banks that do this. Not all of them do. And then we have the big five, and then there's other alternative ones as well that lend on this.
You may have touched on this earlier. I can't remember, but am I incorrect that you can either go through the banks to leverage the money out of these policies, or you can get it directly from the insurer themselves, but the interest rate's a bit higher? Yeah,
that's spot on, right? Yeah, that's exactly right. You can go. There's pros and cons of going with each, but you can borrow directly from the insurance company. That's a really easy process if you borrow from the insurance company. It's a one-page form you request the funds. Yeah, usually the interest rate's a bit higher, and there's some tax implications when borrowing from the insurance company versus a third party, like arm's length kind of loan. Yeah. But in short, yes, you can borrow from the insurance company, you can borrow from a third party for sure.
Those are the cons that Rob's kind of talking about. Some of the pros of borrowing from the insurance company is it's a one-page form, you send it in, they're contractually obligated to give you that loan. So you'll receive the money like within a few days. Another big thing about it, actually, it doesn't report to any credit. So it's like a private loan. It's a private unstructured loan. And so it's really good to be able to just privately borrow money from an insurance company. And then it's an unstructured loan, so you can choose how you repay it. So obviously they set the interest rate, but you set how you repay the money. So you could, if you're doing a deal and you're not expecting the money right away, you could just not pay for a while, do some repayment, turn it on, turn it off. You fully control how much you give them every month or every year, which is huge. It's very difficult to get that type of lending facility.
Right. So instead of, like a mortgage where you've got the set equal payments, I can pay them back whenever, whether it's in 10 years or I want to do $100 a month. It's up to me on my schedule.
Exactly.
Wow.
Yeah, exactly. It's literally on the form. It's like, how much do you want to pay back? And you choose, which is kind of nice. Where, if you go to a third party bank, they'll usually want interest only. But similar with the third-party bank, the loans generally they won't show up on credit as well.
Okay, and then I also just wanted to ask, I've been hearing more and more about infinite banking. Does that have anything to do with this world, or?
Similar.
That's kind of where the infinite banking was started. It's a book written by a guy named Nelson Nash, and he really kind of coined the idea of using the insurance policies as a lending tool, and a lot of times using it to kind of finance your life. What we're seeing is on this side, and that's really it's an American book, and it's a really American concept. So you hear a lot of it online or as sort of a concept down there, but it's definitely the premise and the core idea is definitely it's based on that concept of the infinite banking concept for sure.
So, Roderick, things like infinite banking, cash flow banking, private family banking, there's all these names. And even what we're talking about on the bigger scale, the commercial lending, was called an immediate financing arrangement, or you could have insured retirement plan. They're all essentially the same thing. It's building cash value inside the policy and then leveraging against it. The reason it has all these different names is all these different people have written their financial books on these things. So they always have to, you need to trademark your own thing. So they all call it something, their own brand, right? And then the banks also all have their own names for all their different types of loans. So the banks have their own little interior vernacular that they use for it. So the concept is the same for all of these things. It just depends on who wrote the book and what their book title is, but the general concept is the same.
I heard infinite banking. I thought you guys were referring to Rod's checking account because he gets so many checks from our office. I just thought it just keeps going. I wasn't.
Roddy, the dump truck McKay with the infinite bank.
You're gonna have people coming to me for loans, and I'm still paying off my loans. So you got to watch what you say on the podcast here.
But hey, if they come for you for a loan. They come for you for a loan and they got a life insurance policy, you can maybe lend money against that.
Against that dividends. Okay, now we're thinking here. Okay, I like it.
Roddy, I need a podcast partner who pumps my tires as much as Cory pumps yours, man. This is amazing.
He's a good man. He's a good man.
He gave me $40 before we turned on the recording button.
Wingman game on Maverick.
Yeah, I gave him $40 leverage from my whole life insurance policy.
Guys, before we let you go, we appreciate you taking the time to join us today. We have a 6-pack of lighthearted questions that we ask everyone to get to know you a little bit better outside of the office. Do you have a few more minutes for us?
Sure.
Yeah.
The 6-pack is powered by our great friends over at Red Point Law.
Oh, the guys at Red Point Law are fantastic, Cory.
For all your legal needs when it comes to commercial real estate, visit them at redpointlaw.ca. All right, guys, easy question. We'll throw you a softball here to start. Favorite vacation spot when you find the time?
I'll go first. Usually I try to get down to Mexico, Puerto Vallarta.
PV.
Get down in Nuevo and hit the beach and just relax, have a couple margaritas.
Great food down there. Love PV.
Oh, yeah.
Laurent?
Beach in Costa Rica or Europe.
Very nice. All right.
Very nice.
Number 2, a book that everyone needs to read.
Oh, That's a good one. Well, you brought it up. People should definitely read the Infinite Banking Concept. There you go. It's a short read. You could probably get it done in a couple hours for sure.
Okay, I'm writing that
it's
down.
81 pages.
Okay, I can do that.
So you're
bang it out.
Number 3 is you're sitting at a bar in Mexico. You've had a couple beverages. Someone sticks a karaoke mic in your mouth. What are you singing?
Oh man, that's a tough one too.
Let's do Bon Jovi. You Give Love a Bad Name.
Oh yeah, that's a good one. There you go. I was gonna say like maybe throw
Rob,
some
you can do
in there, but it's a little bit stereotypical. Like last song of the night.
Yeah, Rob, you can do Whitney Houston or something.
Sounds like Rod's iPod.
No, mine's Gloria Gaynor.
Gloria Gaynor. Yes, I will survive.
I will survive. Yeah. Oh yeah, that's the
Do
one.
it.
Okay, so number 4 here. Favorite bar or restaurant?
Laurent, you got to have a good one there, man. You're the bar and restaurant guy.
Yeah, I like Nightingale actually as a restaurant. We're going to go check out Hydra. Heard some good things. I like sitting at the Kiefer Bar. I like sitting at the bar up the stairs to the right in the Rosewood Hotel. It's a random little spot.
Okay, very nice.
You can find Laurent at many a bar.
I was just saying, it sounds like a city tour.
There's good happy hour cocktails at Highs.
What about the liquor locker at the Vancouver Club? Nice bottle of your choice of whiskey.
Yeah,
Yes,
we got that
amazing.
fully stocked. If anyone's around, there you go.
All right, guys. Final question for you: favorite band or musician?
Oh man, this is tough too.
So this could be anything.
Anything you want.
Maybe I go classic, like maybe throw Red Hot Chili Peppers in there.
That's a good one.
They
Great
just
one.
released a new album.
That's a great one. They're actually in Vegas, I think, tomorrow.
Yeah.
The 6th, they're in Vegas.
Oh,
I wonder if it'd be something like Stevie Wonder or like Prince or Questlove from the Roots,
There you
Dr.
go.
Dre, Jay-Z,
Oh yeah, okay, very nice.
all sorts. Yeah.
All right, well,
Even LL Cool J, Ice Cube.
oh okay, keep going. I like it.
Oh, I got tons. Gloria Gaynor.
Gloria Gaynor.
Chaka Khan.
That's the one.
Chaka Khan, I'm crushing right now.
All right. Well, Robert and Laurent, really appreciated having you on today. Lots of great info. And I think our listeners are going to be pretty keen to learn more about this in depth. So if they wanted to reach out to you, what's the best way to get in touch with you?
Yeah, website. You can go check out safepacific.com. You can email us, Robert at safepacific.com, Laurent at safepacific.com. That's probably the best way.
Awesome,
If
guys.
you're on Instagram, it's safepacific.com. You can follow us. We got lots of reels. We got lots of videos. Our YouTube channel is actually kind of doing pretty well right now. YouTube/Safe Pacific.
Yeah, lots of really good
We actually
informative
talk
videos
about
on
this
there.
there's more videos about this concept.
Awesome, guys. Well, thank you so much for taking the time to join us today. We appreciate all the insight there, and I'm sure a lot of our listeners will be reaching out.
You know what? Thank you guys. You guys opening up this platform to us and allowing us to talk to your people. It's awesome. I love you guys so much for this.
Sounds good, guys. Have
Absolutely.
a great day.
And I've been really enjoying
Roger.
listening. Thanks so much, guys.
All right, thanks.
Thanks,
Take care.
guys. Take care.
All right, there you have it, folks. Our chat today with Laurent Munier and Robert Trasolini of Safe Pacific Financial.
Rod, I know you've been here for 2 back-to-back episodes, but that was my line you just took.
Well, you know what? I'm thinking of taking over your seat. So,
Well, hey, I'll tell you right now, after I heard the episode when I was in Disneyland, I was a little worried. I didn't know if I'd get the invite back from Adam to come here again today, but thankfully he texted me and said, fine, you can come join Rod again. So we appreciate you. Great episode. There's so much that goes into the life insurance policy side of it. There's tax benefits they talk about there on tax sheltering, some dividends through the policies. But you think a lot of people think that, your parents have all these real estate buildings and they pass away and you just inherit them through the will and everything's good to go. But a lot of people don't realize the potential taxes that are involved with that and how much those taxes can be, especially in the state like Vancouver.
yeah, it sounds like you get hit pretty hard. That's why it's good to have estate planning in place. And it sounds like these life insurance policies are a great way to cover you from that.
So I know I was away last week, so I've been doing catch up all this week. I know Adam touched base a little bit last week. How is the market right now? I know it seems like on a week to week basis. Interest rates are going up. In the States, they had about a 0.75% recent increase. Job markets come out. Housing stats are down. How are we finding it in commercial real estate right now?
Yeah, like I said last week, it seemed like it was slowing down, and I said it was kind of hard to tell because we were heading to August at that point. We had a long weekend. We typically slow down this industry anyway, but then this week comes and I get more phone calls and emails than I've had in the last 3 months. So it's kind of hard to tell. It seems like there's still a lot of activity out there. People still need places for their business. People are still bullish, looking to invest. So bit of a slowdown with the interest rates, but still seems to keep going.
And if people want to find out more how they can get a hold of you for those investment opportunities, Rod, how can our listeners find out more about you?
Yeah, call me on my cell, 604-763-5510. Always open to have a nice chat. Or you can email me at roderick@williamwright.ca.
And these episodes live on VancouverRealEstatePodcast.com. All of them are broken down there, both the commercial side and the residential side. So please make sure you check that out. We have lots of stuff for pre-sale information, all of that. So please go check that out. If you have any questions or whatever, please feel free to reach out. You can reach me at Cory@williamwright.ca anytime. You can find out everything William Wright Commercial at williamwright.ca, as well as you're welcome to call our Vancouver office at 604-428-5255. We'll put you in touch with the best broker in the province for everything you're looking for. Rod, do you have any final words? Because I don't think you're here next week. You're busy selling buildings.
I don't think I got the invite back. I think getting a little nervous. Any last words? Do I still have a job? As a broker.
At William Wright, you do, because you pretty much keep the company going with all your sales. Here, I can't speak for that because that's Adam's call. I am just a number in Adam's system, is what I am.
Yeah, I got it.
All right, guys. Thanks so much for listening. We'll see you next week.
Thanks, guys.
Subscribe today.